Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about first, what to watch at the bell. A fragile record high masks deep anxiety as Wall Street braces for today's critical CPI report. Will the data ignite a violent reversal, or is this the setup for a massive squeeze at the open? Second, alarm bells ring. Shutdown's data fog hides an inflation surge as the Fed faces political siege. Last month's number was artificially low today. The payback arrives. Will a hot print force the Fed into a make-or-break battle that triggers market chaos? Finally, Google skyrockets to $4 trillion as its Apple deal triggers a new AI power play. The blockbuster partnership crowns a new king in the AI war and sidelines OpenAI. Is this the peak of consolidation, or the start of a new antitrust battle that rocks the tech world? A seemingly calm record high close yesterday masks a violent undercurrent. We saw a 500-point intraday swing in the Dow that signals deep anxiety, not confidence. The market is holding its breath for a data point that could shatter the fragile peace between political pressure and monetary policy. The S&P 500 managed to claw back losses to close at a new record of 6,977, up just 0.16%. But do not let the green close fool you. The intraday volatility where the Dow plunged nearly 1% before recovering reveals a market on edge. Investors are frantically trying to distinguish between political noise and actual systemic risk, and capital is quietly rotating into defensive bunkers despite the headline highs. Today at 8:30 a.m. Eastern, the December Consumer Price Index drops. This is the single most critical data point for 2026 positioning so far. Why? Because it lands right in the middle of an unprecedented collision between the White House and the Federal Reserve. With the Department of Justice investigating Chair Powell, the Fed's independence is under siege. Markets currently price in a 95% probability that the Fed holds rates steady on January 29th. But here is the risk. Analysts are highlighting a hot CPI print above the consensus 0.3% month over month would validate the hawks. It would force the Fed to choose between fighting inflation and bowing to political pressure to cut rates. From a capital flow perspective, we are seeing a distinct shift. The volatility index, or VIX, rose only slightly to 15.12, suggesting options markets are not yet pricing in a systemic crisis. However, the bond market is voting with its feet. The 10-year Treasury yield remains elevated at 4.19%. If inflation proves sticky specifically, if we see a print above 2.8% year over year, the Goldilocks soft landing narrative could evaporate. Analysts warn that a hot number today could push yields toward 4.5%, putting immediate pressure on high valuation growth stocks that have priced in a perfect disinflationary scenario. In the technology space, we are seeing a massive divergence. Alphabet shares surged to hit a $4 trillion market cap milestone after confirming its partnership to power Apple's AI features. This validates the distribution moat thesis. Experts have been watching, proving that infrastructure providers win regardless of the application layer. However, contrast that with NVIDIA. Despite announcing a $1 billion partnership with Eli Lilly for AI drug discovery, NVIDIA shares remain flat. This signals that at 40 times forward earnings, good news is already priced in, and the bar for upside surprises has moved significantly higher. We are also watching a critical test for the financial sector, specifically the ETFs tracking major banks. JP Morgan Chase reports earnings before the bell today, kicking off the season. The sector lagged yesterday, down nearly 1%, spooked by the proposed 10% cap on credit card interest rates. However, analysts point out a disconnect here. Major money center banks like JP Morgan are far less exposed to this regulation than pure play card issuers. With the sector trading at just 15 times earnings, a massive discount to the broader market, experts suggest this sell-off might be driven more by political fear than fundamental erosion. Meanwhile, geopolitics is back in the driver's seat for energy. President Trump's announcement of a 25% tariff on goods related to Iran pushed Brent crude back above $64 a barrel. This geopolitical premium is driving capital into refiners and integrated majors, acting as a hedge against potential supply chain disruptions in the Middle East. Finally, we saw a fascinating move in Walmart, which surged 3.4%. The retailer is integrating Google's Gemini AI to drive commerce and is set to join the NASDAQ 100 index. This blurring of lines between retail and tech infrastructure is forcing funds to reevaluate how they categorize defensive growth. The rhythm of this market has shifted from blind accumulation to selective rotation. We are seeing a flight to quality in defensive consumer staples, which led yesterday's gains. The next few hours will determine if that defensive crouch was necessary. The market has priced in a benign CPI. Any deviation will force a rapid repricing of the entire 2026 rate trajectory. Heading into today's open, the market is bracing for a statistical whiplash. The government shutdown is coming back to haunt Wall Street, with today's critical inflation report expected to correct what economists are calling an artificial low. Now, the reason this is so critical is simple. During the shutdown, the Bureau of Labor Statistics couldn't collect all its price data. So for uncollected items, they used a method called carry forward imputation, which basically assumes the price didn't change from the month before. The problem, of course, is that this method can seriously underestimate inflation when prices are actually rising, creating what experts call data fog. This makes it incredibly difficult for the Federal Reserve to see the true inflation picture and could lead to a policy mistake. This ties back to what we've been saying about how the shutdown muddied the numbers. Today's print is where that fog starts to lift. Now, get this. A Reuters survey of economists predicts a meaningful payback. The Consumer Price Index, or CPI, is expected to have jumped 0.3% in December, with the core number that strips out food and energy also rising 0.3%. And an often overlooked factor here is that for the past year, a key reason overall inflation has cooled is because the prices of goods, things like cars and furniture, have been falling. This global goods disinflation was a major tailwind that allowed the Fed to pause its rate hikes. At the open, watch for the details in this report. If it shows that this trend of falling goods prices is over and is now reversing, it would remove that critical tailwind, forcing the Fed to focus much more aggressively on the still sticky inflation in the services sector. And per economist estimates, the broadest pop is likely to show up in goods, while much of the rent recalibration will filter in later. This isn't just about rising prices, it's about the market waking up to a reality that was temporarily masked. This anticipated rebound in inflation is set to cement the Federal Reserve's decision to keep interest rates on hold, pouring cold water on any lingering hopes for a rate cut this month. But the data is only half the story. The real drama is happening behind the scenes. According to one economist, the market is dealing with a lot of manufactured uncertainties generated by Washington, a direct shot at the escalating tension between the Trump administration and Federal Reserve Chair Jerome Powell. Just a few days ago, this escalated beyond rhetoric. Powell called the Justice Department's probe a pretext to influence policy against a broader backdrop of threats to fire him and even a Supreme Court fight over whether a president can remove a sitting Fed governor. Today's inflation reset is landing right in the middle of that storm. This is wild because it's a direct challenge to the bedrock of a stable modern economy, an independent central bank. What's really at stake is the risk of de-anchoring inflation expectations. Essentially, if businesses and consumers start to believe that political pressure will force the Fed to keep interest rates artificially low, they will start expecting higher inflation in the future, and they will act on it by raising prices and demanding higher wages. This becomes a self-fulfilling prophecy. Ironically, to prove its credibility and fight this perception, the political pressure could force the Fed to be even more hawkish, not less. It creates what we've previously called a credibility gap. And for now, surveys like the University of Michigan still show long-term expectations as stable, emphasis on for now. So as trading begins, the focus isn't just on an inflation number. It's on how the market will price in an economy where the data is correcting from political disruption and the central bank tasked with managing it is facing unprecedented political pressure. And that's exactly when markets start adding a political risk premium. So keep an eye on three telltales at the open: the 10-year Treasury yield as the economy-wide borrowing benchmark, the US dollar index to gauge confidence in policy, and gold as a real-time barometer of trust in US institutions. We've just been talking about manufactured uncertainty in Washington, but let's shift focus to Silicon Valley, where a new partnership is creating certainty and a $4 trillion valuation. Two of tech's biggest rivals are joining forces in a blockbuster deal, shaking up the entire artificial intelligence landscape. Apple announced it will use Google's Gemini AI to power its revamped Siri, a multi-year deal that immediately sent shockwaves through the market. This is the clearest sign yet of a power shift we've been tracking at the very top of tech. This is where the situation takes a more complex turn. The deal structure is likely modeled after the incredibly lucrative search agreement Google already has with Apple. The emerging business model for these powerful AI foundation models isn't direct-to-consumer subscriptions, but rather massive business-to-business licensing deals to secure distribution. This favors companies with deep pockets, like Google. It confirms a playbook we've highlighted before. The AI race is a distribution game. The vote of confidence in Google was so strong, it helped propel the market valuation of its parent company, Alphabet, above a jaw-dropping $4 trillion. The deal gives Google's AI access to Apple's installed base of more than 2 billion active devices, a massive strategic victory. You know, we've been calling out the AI shock premium for a while, and Alphabet had already edged past Apple in market cap. This pushes that leadership narrative even further. The blueprint for this is something we've seen before. Google's existing deal to be the default search engine on Apple's Safari browser. For context, Google pays Apple an estimated 36% of all search revenue generated through Safari. These payments, known as traffic acquisition costs, were over $13 billion in the last quarter alone. This AI partnership is expected to follow a similar licensing path, cementing a powerful revenue stream for both giants. That kind of default placement, as we've noted, is incredibly effective at concentrating value, but this alliance is a major blow to another key player, OpenAI. An analyst from Equisight's research said it best, noting that Apple's decision shifts OpenAI into a more supporting role, with its ChatGPT now positioned for secondary queries rather than being the default intelligence layer. Actually, this highlights a key vulnerability for pure-play AI startups like OpenAI. Without the massive cash reserves of a Google or Microsoft, they can't compete in these multi-billion-dollar bidding wars for default placement on major platforms. It's all part of that AI CapEx supercycle we've mentioned, where the biggest balance sheets are buying up the most important digital real estate. The core conflict is clear, and it's drawing fire from other industry titans. Elon Musk weighed in, calling the partnership an unreasonable concentration of power for Google. Musk's comment isn't just corporate rivalry, it points to a serious and growing concern for regulators. This deal is a prime example of AI platform consolidation. However, if you zoom out, you'll see another layer to this. The consolidation of US tech power is triggering a global reaction. It's accelerating so-called sovereign AI initiatives, particularly in the European Union and China. These blocs are now pushing harder to develop their own domestic AI models and infrastructure to reduce reliance on American technology. For China, this means an intensified focus on self-sufficiency in AI, which could impact everything from local tech employment to global supply chains as a new kind of tech arms race heats up. This all sets the stage for a dramatic market open. Watch for movement in shares of Apple, ticker AAPL, as investors debate whether this is a smart partnership or an admission that its own AI efforts have fallen behind. Remember, Apple's whole strategy was a privacy-first, on-device approach, and its next-gen Siri was delayed. This partnership looks like the bridge over that gap. So the real question becomes understanding a potential strategic shift for Apple. For decades, its competitive advantage was vertical integration, controlling the hardware and the software. This deal suggests a new strategy of ecosystem curation. At the open, look for how the market prices this shift. Is Apple still valued as a top-tier innovator, or is it becoming more of a platform that relies on others for core technology? Keep an eye on Alphabet, ticker Google, to see if it can build on its massive valuation surge. And don't forget the ripple effect on Microsoft, ticker MSFT, the primary backer of OpenAI. This just adds to Alphabet's momentum, which we've seen building up and down the stack from models to custom silicon, and today's distribution win could amplify that. Beyond these three giants, this deal accelerates a much broader trend. The AI infrastructure capital expenditure cycle. To power these massive AI models, you need more data centers, more specialized chips from companies like NVIDIA, and more electricity. This creates a durable picks and shovels investment theme. So at the open, also watch the semiconductor sector and data center stocks. After all, power constraints and the end of cheap compute just keep pushing those budgets higher, favoring the builders of the infrastructure. The opening bell today will be the first test of this new world order. kicking off the next major battle in the heavyweight fight for AI supremacy. And as leadership narrows, keep an eye on QQQ and the VIX for any telltale signs of crowding and volatility.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.